Hi, welcome to On Air. I'm Klara Syrewicz. Just when you thought we'd end the year on a high note, let me ruin this. It's time we talked about recession and a not-so-hypothetical AI bubble. The word crisis is the season's headline filler, from the cost of living crisis to an apparent crypto crisis. And yet, COVID aside, it's been over 15 years since the last global recession. According to the New Yorker's David Remnick, Trump privately conceded that his tariff strategy could trigger a recession, but insisted his real goal was simply to avoid a depression. So this looming catastrophe has been on the menu for a while, which brings us without further ado to the question that will haunt the coming year. Are we sleepwalking into disaster? Because if we are, the most likely detonator will be the US economy. Geeta Gopinath, former IMF chief economist, recently warned the world has become dangerously dependent, both domestically and internationally, on US equities. According to The Economist, 30% of US household assets are now tied to the stock market, an all-time high, fueled by booming tech stocks and European investors gobbling up American equities. Now, imagine a dot-com-style crash. In today's economy, it would wipe more than $20 trillion from American wallets. That's about 70% of last year's US GDP. The shockwaves wouldn't stop there. Foreign investors could lose another $15 trillion, erasing roughly a fifth of the rest of the world's GDP. At this time, there'd be little room for rescue. Consumption is weaker, government debt higher, hence a fiscal stimulus as defibrillator for the economy would be limited. So why this anxiety about the US economy? Since Trump's tariff extravaganza, he's calmed down, growth has held, and markets are sitting at record highs. Everything looks fine. I'm fine. Because forecasts are about as stable as US leadership, let's step into the matrix and consult the oracle.
You know why Morpheus brought you to see me.
Today's oracle is Polymarket, at least according to its chairman's interview on 60 Minutes. This crypto betting platform lets users wager on everything from elections to weather. Right now, it puts the odds of a 2026 recession at about 30%, down from 43 months ago. Wow, that sounds okay, right? Well, not if you ask anyone outside the Trump administration. A growing chorus, much of it currently heading to Davos, expects a market correction, if not tomorrow, then soon. Moody's economist Mark Zandi, hardly a doomsayer, calls the risk uncomfortably high, putting the odds of a US recession at 48%.
It's less than 50%, but historically, the probability has never gotten this high, and a recession has not ensued.
He's not alone. Société Générale's veteran strategist Albert Edwards agrees, and JP Morgan has raised the odds of a recession to 60%. Investors are jittery as the Fed's independence crumbles. Trump is gearing up to install a new Fed chair, presumably someone whose first qualification will be unquestioning obedience. The US bond market, usually a canary for the economy, has calmed after some explosive volatility around Trump's tariffs, but this seems eerie while other indexes are showing stress. The answer is simple. The Treasury has become a big buyer of its own debt. So far, the plan seems to be working. But as bonds mature, the money supply will have to balloon to match the debt, which is currently 1.5 times bigger. This translates into very high inflation, a hidden tax on anyone holding money reserves. Then there's the so-called potential debt. The US government keeps promising bailouts to many sectors, from guaranteeing household deposits to protecting mortgage lenders in case of default. Those promises now total over $130 trillion, so nearly 5 times the US GDP. Imagine having to cover all of that at once. Suddenly, we're flirting with a Germany post-World War I scenario where you lose half your wages by the end of your shift. Economic anxiety is creeping in, and people are already changing how they spend. Travels, hotels, dining out, those budgets dip before official statistics catch up, while essentials like food, housing and healthcare suddenly take up a bigger slice of the pie. These indicators are on. Then there are the wild ones. Recession hair, people skipping haircuts like in 2008, or the lipstick index, with sales rising when times get tough because consumers favor inexpensive luxuries. Even the foreboding recession gardens trend online, presenting vegetables that will slash your grocery bills.
This is about surviving a recession.
Mostly jokes, sure, but like any viral meme, they reveal a common anxiety, each like and share reinforcing it. Yet the most troubling whispers focus on the AI bubble. As Andrew Ross Sorkin notes in his book on the Great Wall Street Crash in 1929, back then, a similar technological euphoria gripped investors, promising to transform the world. It was automobiles, phones, radios, and advanced aircraft. Today, it's AI and space tech. The thrill fueled big spending, but profits lagged. While these innovations did change the world, their economic returns were not instantaneous. And remember the internet exuberance of the late 90s. Today, the world runs on the internet, but back then it had not yet achieved widespread adoption. That lag, plus other economic factors, sent the dot-com bubble crashing. Here's how this moment is dangerously similar. A handful of tech giants like Alphabet, Amazon, Meta, Microsoft and Oracle, not that Oracle, are driving most stock gains. They are used to reaping huge profits without encountering too many investment hardships. But now they must spend massively to stay in the AI race, building data centers packed with expensive NVIDIA chips and mammoth electricity farms. They're betting on big future returns, which may eventually materialize. But for now, it's a vertigo of expenses. Those amount to $400 billion this year, more than the Apollo Moon program's $300 billion adjusted for inflation, and spread over 10 years. And they're collectively funding a new Apollo mission every 10 months. UBS predicts AI expenses will hit $500 billion next year. That's Singapore's entire GDP. Meanwhile, US consumers shell out just $12 billion on AI, roughly Somalia's GDP. And that's despite the fact that large companies are already spending heavily on AI. IBM says a typical firm juggles 11 AI models, while vendors keep pitching platforms for every imaginable task. I wouldn't be surprised to find one in a toilet paper dispenser. Yet an MIT report found that around 95% of organizations aren't seeing real benefits from AI yet. Meanwhile, AI is sucking capital from other sectors, especially manufacturing, much like in the dot-com boom. And there's the power crunch. Data centers already use 2% of the world's electricity. By 2028, the US might not have enough terawatts to keep up, even if new plants are being built. So where is all the money coming from? Surely huge profits. Meta, Amazon, Google aren't exactly broke, right? Well, not anymore. Techland is running out of cash and increasingly relies on debt. Just like in 1929 and 2008, borrowing fuels the hype. Meta's Reality Labs lost $70 billion over 4 years, with $30 billion borrowed in October alone. OpenAI bleeds $12 billion every 3 months, with $44 billion more expected to be lost by 2029. And Amazon's free cash flow has been cut in half this past year, half of it probably spent on renting Venice. And it's not just the tech giants piling on debt. Real estate, construction and energy companies are all borrowing big to build the AI ecosystem. But what happens to them if the people meant to pay them back can't? And finally, there's the dodgy financing. Most loans now come from what's called the shadow banking system and private credit funds, so financial middlemen the Fed has little insight into. If the market corrects and stocks go down by just 20 or 30%, these companies could actually owe 3 or 4 times that. Which brings us to the mind-boggling leverage. When OpenAI commits $100 billion to NVIDIA, but doesn't have that money, NVIDIA finances OpenAI. So NVIDIA is giving OpenAI the money that OpenAI will pay back NVIDIA if it succeeds. But who cares when both their valuations have been pumped in the process? Money just loops between a few giants, obscuring its provenance and making the market look busier than it really is. Harvard economist Jason Furman recently warned that if stripped of all the spending on AI, data centers, chips, etc., the US growth rate would be 0.1%, basically flatlining. This illustrates not just how everything depends on AI growth, but also how it may be masking deeper problems in the US economy. Financial bubbles are hard to predict until they burst, and unfortunately it pays off to inflate them until the very last minute. In the best scenario, today's exuberance with no clear path to profitability could mirror the dot-com era, producing lasting innovations and causing limited economic pain. Except now, a lot more wealth is at stake, and there's far less room for policy to soften the blow. Coincidentally, the term debasement trade, essentially buying things like gold because you worry other assets will collapse, was a contender for The Economist's word of the year. But in the end, 2025's top word was slop, a bow to the explosion of crappy AI-generated images and videos. It's our last programme this year, so we decided to ask our colleagues from TVP World and affiliated foreign language stations what were the most impactful and memorable moments of 2025.
As 2025 comes to an end, one question emerges. What will this year be remembered for? We asked analysts, journalists, and correspondents to name the defining moment of the past 12 months. For many, the answer began in Washington.
I think one of the most defining, if not the most defining moment was the re-election of Donald Trump for the second term as President of the United States. It has a huge influence on the state of security worldwide, and in particular in Europe, Central and Eastern Europe, and it has huge influence on whatever's happening in Ukraine with the Russian invasion, Russian war. These are all events and situations that will probably define the future of this continent and probably the world for decades. And we have to be very careful and be able to read whatever's on Donald Trump's mind. It's not very easy often.
Symbolic moment. It was the meeting between Donald Trump and Vladimir Putin. It is both symbolic and politically dangerous because it is just like a symbol of new era, Donald Trump era of politics of power, and coming back to the situation where force is the most important, alliances don't matter much, and the treatment of the countries depends on their capacity of balancing in between these big powers. Europe is really in a big problem.
For colleagues over at Slava and Belsat, the defining moments in geopolitics were also personal.
For the whole world, I believe that the most important moment, crucial, pivotal moment, is the new strategy of national security of the United States. But for us, as Belarusians, two big releases of political prisoners. And then we saw finally and hugged our colleagues, 8 journalists of Belsat, who are free now, but we are still fighting for the rest to be released.
The most important development of 2025 is the launch of Pearl, the prioritized Ukraine requirements list. Thanks to funding from our allies, Ukraine can receive crucial US weapons and equipment that gives us the capability to hold the front line and to protect our cities from Russian aggression. At the same time, we see a crisis of political leadership around the world. That is why it is crucial to respond to Russian aggression as firmly as Poland does, our main partner and ally.
But for some who reported the stories day after day, there was no moment more defining than the unrelenting continuity.
We have one major event to report on every day, which is, of course, the war in Ukraine. And TVP World, because of its location a few hundred kilometers from the front, is best position of all TV news channels in the world to properly report on it.
2025 has undoubtedly been difficult. We step into the next year knowing the story isn't finished, and neither is our responsibility to tell it.
Stay with us next year as we bring you more exclusive coverage and hopefully a few laughs from me, even when times get tough. Have a fantastic New Year's Eve, and I'll see you next Saturday.